Alright, today's video is going to be a bit different. Instead of talking about Bitcoin directly, I want to zoom out and look at the bigger picture, the macro environment, because when you actually look at the data, it's not that bad. In fact, I'd say the macro still looks pretty strong. So I'm going to walk you through 3 bullish charts and 1 bearish one, and at the end, I'll share a bonus bullish point that I think people are seriously underestimating. The first one is this one. The ticker's WALCL. This is the Federal Reserve balance sheet. This tracks how much money the Federal Reserve has created and basically how much liquidity is in the system. Everyone's talking about QT, quantitative tightening, like it's killing the markets, but if you look at this chart, the balance sheet has barely come down when you compare to how much it ballooned in 2020 and 2021. We're still sitting at over $6.6 trillion in liquidity. That's not tight, that's just a ridiculous amount of money. And Powell recently hinted that QT probably will be coming to an end. When that happens, QE, the next round of liquidity, will follow. And when QE comes back, risk assets pump, so that's a bullish chart. This is the tip IEF ratio, inflation protected versus regular treasuries. This ratio shows what the bond market expects for real growth and inflation. Now, when it goes up, that means investors are confident and that growth will hold up and inflation is manageable. Right now it's stable. It's not rolling over and it's not crashing. That tells me that the bond market is fine and the economy is fine. If this chart starts collapsing, that's when I'd get worried. But it's holding firm. And if we overlay US market crashes and also the S&P 500, you can see that there is some kind of correlation here. So when this falls down, the markets do fall down. Over here and over here as well. And when this goes up, the markets go up. And when it's just ranging, then yeah, that's a decent sign for the economy. So this is still looking good in my opinion. And there's still room for this to go up. Now this chart here, this is the high yield credit spread. This measures how much extra interest investors demand to hold riskier corporate debt compared to safe treasuries. So when this spikes, it means there's panic. And that's credit stress and financial cracks in the system. When it's calm, it means that the system's functioning well. Like over, again, we can look at the overlay, with the market crashes in the S&P 500. When this spikes up, there's usually some kind of problem. And so this is holding steady right now. It's flat, it's stable. So this tells me that the credit markets are still healthy and no one's panicking. Now this one over here, this is a difference between the 10-year and 2-year US Treasury yields. This is a really good indicator for recessions. As this pumps up, it normally means that bad things are coming. Now whenever this chart drops below 0, that's an inversion. And it's usually a sign for trouble ahead because it's really at the bottom. Now we've been inverted for a while now and we're finally starting to uninvert, meaning it's trending back up. Now here's the key. Every time this chart starts rising again, like it's doing now, markets do fall. That's the lag effect from those high interest rates finally hitting the economy. So short term, this is bearish. But, and this is crucial, this phase is also the final stage before the next cycle begins. So once the Fed cut rates and liquidity returns, this resets the system. So yeah, this is the only chart that I'd say is looking bearish for the economy, because generally speaking, as this spikes up, you can see the S&P 500 here, it goes down. And this is the only one where I'd say, okay, if this continues to go up, then yeah, bad things are coming. Now I said at the end I'd give you 1 bonus point, and the bonus point really is the Trump factor. Look, we got to remember who's in charge here. Like if you were in power and your friends had lots of money tied up in the markets, would you let it crash? Probably not. And this is your own money as well. And even if it did crash, you'd probably do everything you can to make things right. Just like over here. Like in March, earlier this year, things crashed, but then it quickly turned around. Trump understands the markets better than most people. Like he knows that liquidity and confidence drive everything. So he's not going to sit back and watch his own portfolio and his friends' portfolios get wiped out. So if things get rough, he's going to push for stimulus, and that is going to be QE, and that's going to keep everything pumping. And really, it's demand and supply. It's economics. As the money supply goes up, there's just more money to pump into the system. More money equals more demand, equals prices rising. So yeah, I'm not panicking. I do think things are going to continue to go up. That isn't to say things are more valuable. It's just demand and supply economics. This is going to be one of the main charts that I look at. When this starts to go up, and this has pretty much been drained out. This was sitting at $2.5 trillion. Now it's only at 4 billion. There's no more liquidity left to put into the markets. Really, it has to be more M2 money printing. And it's coming. It is coming. This chart, just like it always has, is going to continue to go up.